Happy Friday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Before we jump in, one quick piece of housekeeping. I am feeling quite under the weather. As such, I will be taking tomorrow off, and we will be back to regular episodes on Monday. There is so much important stuff to cover from today, though, that I had to put this episode up. Now, with that said, let's jump in, and we start as we usually do with the Chinese economy. After several years of decline, China's property market showed tentative signs of stabilization in January, as home price declines slightly narrowed, suggesting that Beijing's policy measures are having some effect. According to calculations by the US-based Wall Street Journal, based on data from the National Bureau of Statistics, average home prices across 70 cities dropped 0.07% from December, a slight improvement from the previous month's 0.08% decline. We do note that this number is politically sensitive, and so we take these data with a very big grain of salt. We also note, of course, that this still represents a decline, which in of itself is telling. Among these cities, 42 reported monthly price drops, down from 43 in December. On a yearly basis, prices fell 5.4% in January, easing from December's 5.7% drop. While this indicates some stabilization, analysts remain cautious about the sector's long-term outlook. Japanese bank Nomura analysts warn that the property downturn is far from over, with price declines likely to continue well into 2025. While major cities have seen moderate improvements, lower-tier cities remain under pressure due to oversupply and weaker economic fundamentals. This will, of course, all be very familiar to regular China Update viewers. Goldman Sachs economists note that while recent policy interventions have boosted home sales, further measures are necessary to sustain recovery. With structural challenges persisting and policy support still limited, the real estate sector is expected to remain a drag on China's economic growth for the coming years at least. Meanwhile, leaving the mainland now, Hong Kong's prolonged property market downturn is testing its status as a low-tax financial hub, with growing concerns about the sustainability of its fiscal model. As Financial Secretary Paul Chan prepares to unveil the territory's budget, economists suggest that a tax review may be necessary to address ongoing deficits and rising costs. Historically, Hong Kong has relied on land sales as a primary revenue source while maintaining low taxes on income and corporate profits. However, the combined impact of a sluggish Chinese property market and the financial demands of an aging population has led to persistent fiscal shortfalls. The city has recorded deficits in 4 of the last 5 financial years, with another projected for the 24 through 25 financial year. UK-based The Financial Times writes this week that with land-related revenues falling sharply, policymakers are considering alternative sources of income. Revenue from land premiums has plummeted from 143 billion Hong Kong dollars in 2022 to just 20 billion Hong Kong dollars last year, an incredible and painful 86% drop in revenue, and it is expected to drop further. Thus, this really does look like the end of this fiscal model for Hong Kong. Slumping commercial rents and declining residential prices have dampened developers' willingness to invest, exacerbating the government's fiscal woes. Meanwhile, stamp duty revenue has suffered as property transactions slow. Some lawmakers and analysts suggest increasing income taxes, particularly for high earners, following last year's rise in the top personal tax rate to 16%. However, experts warn that further hikes could erode Hong Kong's competitive edge. Comparisons to Singapore's 24% top income tax rate suggest more room for adjustment, but any tax increase must be carefully calibrated to avoid deterring businesses and investors. And of course, one of the things that have drawn many from Hong Kong to Singapore is the political environment, rather than just the top tax rate. Next up, and while we're on the Chinese economy, in a piece published earlier this week by Caixin, the Chinese financial media outlet, argues that China's most economically significant regions are under mounting pressure to sustain GDP growth in 2025 amid global uncertainties and a challenging domestic landscape. With national economic expansion slowing officially to 5% in 2024 from 5.2% the previous year, provincial level governments have been called upon to spearhead growth, focusing on boosting consumption and domestic demand. Of course, as we've discussed in previous videos, this growth in reality is likely much lower, but the fact that official growth targets continue to drop is in of itself telling. In a strategic article published in 求是, or Seeking Truth, Han Wenxiu, a senior economic official, emphasized the critical role of the top 10 provincial economies, which collectively contribute over 60% of China's GDP and industrial output, while handling 80% of the nation's trade. The message aligns with the central government's economic priorities outlined in December, which stress expanding domestic demand and increasing disposable incomes for low and medium income groups. However, as we discussed earlier this week, even some of these most economically dynamic regions and cities are facing difficulties that up until recently were most pronounced in the poorer regions of the country. As we saw, Shenzhen saw its fiscal revenue drop for the first time since 1990. Notably, major economic hubs such as Guangdong, Jiangsu, Shandong, and Zhejiang refrained from setting explicit fixed asset investment growth targets, a key driver of growth in the past, one that has been tied, however, to surging unsustainable debt. Meanwhile, Chinese financial media outlet Yicai reports this week that Chinese administrative regions anticipate a nearly 3% rise in fiscal revenue this year, reflecting a slower pace compared to 2024 as they adjust to economic challenges with increased government stimulus. Luo Zhihang, chief economist at Yuekai Securities, noted that the national general public budget revenue is expected to grow around 2%, less than half of last year's 4.4% target. And we remember this comes within the context of years of fiscal deficits. Regional governments are aligned with the central government's proactive fiscal policies, including increasing deficit ratios and issuing more special bonds. However, subdued demand, falling prices, and real estate tax incentives have constrained revenue growth. Debt-laden regions face further limitations in raising funds. To ease budget pressures, the outlet adds, China may raise its fiscal deficit to GDP ratio above 3.5% and expand its special debt quota beyond 4.5 trillion yuan to stimulate investment and housing demand. And finally, for today, we move to Chinese AI moves. But just quickly, if you're getting some value from today's episode of China Update, don't forget to hit the like button. DeepSeek, the AI startup spun out of Chinese quant hedge fund High Flyer Capital Management, is reportedly considering raising outside financing for the first time. According to US-based technology outlet The Information, the company's shift toward external investment is driven by its growing need for high-powered AI chips to support its chatbot and broader AI model development. The move is a notable departure from DeepSeek's previous strategy of self-funding, which was designed to avoid external pressures for rapid commercialization. However, the surge in usage of its AI language model has placed a strain on its computing infrastructure, prompting executives to rethink their funding approach. Among the potential investors are major Chinese firms including Alibaba Group and state-affiliated funds such as China Investment Corp and the National Social Security Fund. One of the biggest hurdles DeepSeek faces is securing enough NVIDIA AI chips, particularly after US export restrictions limited China's access to cutting-edge models. The company has been using NVIDIA's A100 chips, acquired before the restrictions took effect, but now seeks more advanced alternatives. To circumvent these restrictions, DeepSeek is reportedly exploring the use of data centers in Malaysia to access NVIDIA chips more powerful than the H20 model. This strategy aligns with actions taken by other Chinese AI firms, such as ByteDance, which have rented NVIDIA-powered servers outside of China to maintain their AI development without violating US regulations, that is, unless and until Washington updates its policy. The potential funding round, coupled with efforts to secure top-tier AI hardware, signals bullish prospects for NVIDIA, which continues to dominate the high-performance AI chip market. Additionally, if geopolitical dynamics shift, particularly if a US-China trade deal under the current Trump administration emerges, something which we discussed in yesterday's video, DeepSeek could gain more direct access to NVIDIA's technology. Indeed, it is with the technology war that the friction within the US administration between a grand trade deal and national security considerations is perhaps most acute. Meanwhile, Alibaba has announced an aggressive investment strategy in artificial intelligence, aiming to solidify its position as a leader in the rapidly evolving tech landscape. Yesterday, Thursday, Chief Executive Eddie Wu revealed that the Chinese e-commerce giant plans to invest more in AI and cloud infrastructure over the next 3 years than it has in the past decade. However, the company did not disclose specific figures. In 2024 alone, Alibaba's capital expenditure surged to $10 billion, tripling its investment from the previous year. Much of this spending has gone toward acquiring high-performance processors and infrastructure essential for training large language models. The company is particularly focused on developing artificial general intelligence, AGI, capable of human-like reasoning and problem-solving. Alibaba's strategic push into AI comes amid strong financial performance, with an 8% revenue increase in the last quarter of 2024, reaching $38 billion. The group's cloud computing division played a key role, growing 13%. International e-commerce also saw impressive gains, with sales rising 32%, driven by AliExpress. With all of this said, investor confidence has surged, pushing Alibaba's stock price up more than 50% since the beginning of the year. Though we do note this is from a relatively low base, after the company had to go through years of a regulatory crackdown and the uncertainty that presents. The company has also benefited from the return of its co-founder, Jack Ma, who recently attended a high-profile meeting with General Secretary Xi Jinping. We covered this at the start of the week. As the US-China technology war intensifies, Beijing continues to pour massive resources into this chip and AI race, as it now sees this next industrial revolution as critical to its competitiveness, economically and militarily, for decades to come. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Friday, have a restful weekend, and I will likely see you back for a new week of updates on Monday.